Okay. Uh, so from Auditing and Assurance Standard Board of ICI, we welcome to all at today webinar on companies auditor report order, commonly known as CARO. So we are truly honored to have with us today our esteemed speaker, CA Anil Sharma ji, who is widely recognized for CA Anil Sharma ji is a practicing chartered accountant for last 45 years, and he is in faculty with the Indian Institute of Corporate Affairs, set up by Ministry of Corporate Affairs, Government of India. He is also a special invitee to ASB of ICAI for the year of 2025 to 26. And he was a member of National Financial Reporting Authority that is nominated by Ministry of Corporate Affairs during 2020 to 23. He was also a non-executive independent director of UCO Bank for a period of 3 years from 2016 to 19. And he was a special invitee to NACAS during the period from 2014 to 18. So now I over to you, our speakers, C. Anil Sharma sir, to start this webinar. Over to you, sir.
Thank you very much, and good afternoon. Good afternoon to all the participants who have joined for this particular webinar. So, I have a detailed presentation. I would definitely be taking you through to that. But before that, let me talk about a few other aspects relating to CARO 2020. You see, as you know that section 143 is the main section which deals with the duties of auditors. And if you really see that particular section, there is a subsection 1 that tells you that there are 6 inquiries which are to be made, and if there is any negative observation, then that is required to be reported. And then thereafter, subsection 2 and subsection 3 are the main reports which auditor has to give, including the our opinion with regard to the true and fair view of the state of affairs, as well as the performance of the company for that particular year. And subsection 3 also includes a residuary clause which says that such other matters as may be prescribed. And under the company's auditor and auditors rules 2014, rule 11 has specified certain matters, additional matters which are required to be reported in the report. So that part is our main report. Then we move to subsection 11 of section 143. Now, this subsection 11 gives powers to the central government that they can, in consultation with the National Financial Reporting Authority, and they can specify certain more reporting areas and to specified class of companies where some additional matters are also required to be reported by the auditors. So that is the starting point for CARO 2020. So that is subsection 11 of section 143. So under that, those powers, central government has prescribed CARO 2020. So CARO is not a, first of all, CARO is a very special type of report which contains certain observations which auditor has to give. Some of the clauses are on to the statement of facts which auditor has to verify and produce, and some clauses are where auditor has to express his opinion. So while going through that, I'll point out that what are those areas where we are expressing the opinion, and what are those areas where we are simply verifying and mentioning the statement of facts. So CARO is, if you look at the background of CARO, it is initially it used to be MAU CARO, which was applicable only to manufacturing and other companies, and not to all the companies. But later on, when CARO 2004 came in, then it was made applicable to a large number of companies, virtually all the companies except banking and insurance and some of the specified companies. And then in 2000, when this new Companies Act came in 2013, then CARO was revised in 2015. There were some amendments in 2016 also. And after 2016, there were, as we all remember, that there were a lot of, economic disturbance in the sense banking sector. There were a lot of NPAs were noticed, and after that, with the NCLT coming up, lot of cases were reported where there were where the investigating agencies found a lot of frauds also in those companies which were ultimately dissolved through the NCLT process. So during that period, some observations were made that companies have not reported certain matters, or even auditors has not reported certain matters. So keeping all those observations in mind, CARO 2020 was framed, and a lot of new clauses were added there, and some of them are, you would see when we will go through those clauses, you will find that some of the clauses are directly hitting those aspects which I just mentioned relating to bank frauds, and very large number of clauses were included into this to keep in view the interest of banks and banks as well as other financial institutions, and of course the listed companies who have raised funds from the market, and their liquidity, their financial viability, and all those aspects has been brought into these new clauses. So that is the background in which we will go through each and every clause of CARO 2020. So now let me start with the presentation. Is it visible?
Yes, sir, it is visible, sir.
Okay, good. So background I have already mentioned to you, but one more aspect with this was that when this CARO 2020 was being framed, or rather when 2016 was being amended, at that time this process started somewhere in 2018, and by March 2019 the committee recommended the changes as compared to CARO 2016, and the government came out with a notification where they made this reporting under CARO 2020 from the financial statements for the accounting year starting from 1/4/2019 itself. So 1920 was initially, that was the plan, but as we all aware that since it was very short time given to the company as well as to the auditors, so the applicability date was amended and it was revised and to start from 1/4/2020 rather than 1/4/2019. And again, because of the corona, this COVID-19 started. So companies express their, or even auditors express their inability to go deep into the reporting aspect. So for the applicability was deferred by 1 more year, and it was made applicable from 1/4/2021. So from financial year 2021 uh, uh, to 2022, 21-22 was the first year when this CARO reporting was made applicable finally. So we have already, so almost 22, 23, 24, 3 years we have already reported. So I'm sure by this time you already have gone through these provisions and must have understood the requirement and must be reporting accordingly. See, I would like to just add one or two more points here. If you look at, there are two important reports which are there. One is by Quality Review Board, which is for 23-24 financial year. So they have made observations, and they have found that a very large number of cases auditors have not reported properly in under CARO 2020, and they have pointed out that auditors have been using some scapegoat or escape route to, for example, simply by using generally or something like that, they try to escape themselves from reporting the exact problems in the area, which is again not a good practice, and they have pointed out that. Similarly, there is also a report by Financial Report Review Board, FRRB. So there also they have pointed out a lot of they have studied a lot of financial state reporting, auditors report of various companies, and they have pointed out where the auditor has not done a good job. So my suggestion to all of you is please go through those reports, because that will indicate you that what are those areas where reporting has to be done in a proper fashion, and there should not be any shortcut or escape or using a language which is not desirable or not the exact language which is required to be reported. So I would also be pointing out some of the examples in my presentation, in the course of my presentation. So if you, as an overview, if you look at CARO 2020, you will find there are 21 main clauses. And out of those 21 clauses, there are 11 clauses which has got together in all 38 sub-clauses. So it's a huge reporting. So as compared to 2016, very large new clauses has been added here. And so far as coverage is concerned, it is applicable to, it is not applicable to banking, insurance companies, Section 8 companies, OPC, one-person company, small company, and specified private limited company. So far as specified private limited companies is concerned, if you go through the CARO order, which is the so you will find there that they have mentioned that a private company, not being a subsidiary or holding company of a public company, where paid up capital and reserves are not more than 1 crore and which does not have total borrowings exceeding 1 crore rupees from any bank or financial institution at any point of time during the financial year, and which does not have a total revenue as disclosed in Schedule 3 exceeding 10 crore rupees. So these are the three threshold, and this two of them are to be seen. One is to be seen on the balance sheet date, which is the capital and reserve. Second, which is the total borrowings, that is to be seen at any point during the year. And the third one, which is the revenue, which is to be seen as for the entire year, so during the financial year. So if these three conditions, all the three conditions are met, then that company would be considered as specified private limited company and would not be required to give a report. The auditor of that company would not be required to give report under CARO. So that is I'm sure you are aware of the foreign companies. Foreign companies, here we are those companies where foreign companies set up their branch offices or their project offices in India. And so they become, they are considered as a foreign company. And in those project office and branch offices, project offices, of course, are can only execute the projects for which they have been permitted to set up their offices. And whereas the branches are, they can do all types of commercial activities. And therefore, if other criteria are met, then they would also be, the auditor of those companies would also be required to give a report under CARO. So now one additional point here is that the 21 main clauses, out of that, there is one clause which is clause 21, that is with regard to consolidated financial statement, which is clause 21 in para 3. Now, earlier, CARO 2016, there was no report which was required to be attached to consolidated financial statement. So first of all, let us understand why report under consolidated financial statement is required to be attached. So if you look at section 129, which clearly mandates that if a company has any subsidiary, associate or joint venture, then it has to prepare consolidated financial statement in addition to its standalone financial statement. And the section goes further. It says that the preparation, presentation, disclosure, adoption, audit, all the provisions which are applicable to standalone financial statement would mutatis mutandis would apply to consolidated financial statements also. So it means the entire process of audit, then presenting before the board, and adoption by the board, and finally adoption by the members of the company, that entire process has to be done. And accordingly, auditor's report is also on consolidated financial statement is also required to be attached. So the now clause 21 of CARO, or para 3 of CARO 2020, is one reporting under CARO, which goes with the consolidated financial statement also. So the requirement of that I will tell you once I will go through the entire presentation. So before we go further, another development would be of your interest, and that is the amendment made in Schedule 3. If you remember that during this period itself, massive or very large amendments were made in Schedule 3, where see, a lot of information as a additional regulatory information was required to be presented in the financial statement by the company itself. So the idea was that and in fact, let me tell you the background of that, why those amendments were brought in. See, when these discussions about adding new clauses into CARO reporting was being discussed, so there was an argument from the auditor's side, represented by the institute, as well as I was also one of the member there. So we represented that if you are asking us to report, first ask the management to report, and then we should be verifying that and then reporting. Simply straight away asking the auditors to report may not be a very good idea. So to which regulator side agreed. So you will find that when we'll go through the reporting requirement under CARO 2020, you will find that most of that information is first reported by the management in the financial statement, either in the main reporting format or as a additional regulatory disclosure in the notes to accounts of the financial statements. So please keep that in mind and ensure that so it should not happen that because in FRRB I have seen some of the observations, but like that also, the company management is saying something else in the financial statement, whereas auditor is reporting something else in CARO 2020. That's a very shameful situation where auditor has not even studied the what management is to say. And in some of another important point is before we go further on that, which you should keep in mind, is that there are 21 clauses, and auditors are required to report on each and every clause. Okay, so now there may be a situation where some of the clauses are not applicable to that company, in that particular company. So in that situation, you have two options. One, you give the report verbatim in the order which is there in the CARO 2020, and wherever the clause is not applicable, mention that this particular clause is not applicable to the company. Or second option can be you report only those matters which are applicable, and at the end you mention all the clauses which were not applicable and therefore has not been reported. This is the way how our guidance note on CARO 2020 has also suggested that particular way of reporting under CARO. So now let's go to clause-wise discussion. Now, as you know, that clause 1 of para 3, that is relating to property, plant and equipment, as well as to the intangible assets. So when you are looking at the particular slides, you will find that some of the words I have highlighted as red. So these are some of the changes as compared to CARO 2016, just for your observation, because again it's not a very good way to express, but it has been pointed out by FRRB that some of the auditors have continued to report the format which is there in CARO 2016 rather than going with this new CARO 2020 requirements. So that's again a very not a very good way of reporting. So please ensure that you are reporting in the proper format, which is CARO 2020, which is applicable at this stage. So now if you look at this clause 1A, that has been now divided into two parts, capital A and capital B. So earlier it was company auditors were required to report whether the company has maintained proper records showing full particulars, including quantity details and situation of its fixed assets. So fixed asset word has been replaced with the word property, plant and equipment. And another subclause has been added here, whether the company is maintaining proper records showing full particulars of intangible assets. So now proper records of both property, plant and equipment as well as intangible assets are required to be maintained by the company. And what is proper record? I mean, this we know that so far as property, plant and equipment is concerned, there also is a situation of those assets are also required to be mentioned in that. So earlier we used to say call it fixed asset register. So we can continue to call it, or maybe we call it property, plant and equipment register, and accordingly all the information, including depreciation and amortization details, which has been charged on year-to-year basis, has to be recorded in those records. So far as subclause B is concerned, there is no change. This clause relates to the physical verification. It says whether physical verification by the management has been done at reasonable intervals, whether any material discrepancy were noticed on such verification, and if so, whether the same has been properly dealt with in the books of accounts. So there are two important points here. One is about the reasonable intervals, and other is the material discrepancies. And auditors is required to ensure that these both aspects are taken care of. But in one of the examples which QRB pointed out was that where the auditor has mentioned that the fixed assets has been physically verified by the management at year end. So that is not the requirement. Requirement is at reasonable intervals. And so it has to be reported that way. And material discrepancies were noticed on verification. Sometime the second part, which is, and if so, whether the same has been properly dealt with in the books of accounts. Some of the observations made by QRB was that though the auditor mentioned that there were material discrepancies noticed on such verification, but the later part of the reporting, that how they have been dealt with in the books of accounts, was not reported by the auditor. So please ensure that proper reporting is done in this particular subclause. Subclause C of clause 1. Now here also this is very important clause, whether the title deeds of all the immovable properties disclosed in the financial statement are held in the name of the company. If not, provide the details thereof. So this was requirement in CARO 2016 also, but few changes were made, and that was that they have excluded from the definition of immovable properties properties which are where the company is lessee and the lease agreements are duly executed in favor of the lease. And it is very logical, because when there is a lease agreement, the immovable property cannot be, the title deed of that immovable property cannot be in the name of the lessee till the time he has made all the payments. So since it is the very nature of those agreement, and in those cases title deeds cannot be in the name of the company. Therefore, this exclusion has been made here. So, please don't report all those properties which are under lease and there is a proper lease agreement under this reporting that title deeds of those properties are not in the name of the company. So in addition to that, I am sure that you are aware of a provision of the Companies Act where companies have to record all the properties which are owned by the company but which are not in the name of the company. So that is one. And as I was mentioning, that Schedule 3 also now has a very detailed information on this aspect. Companies are now required to give, by way of a note, a detailed information on immovable properties where title deeds are not in the name of the company, where they have to give the particulars of that property, since when that is not registered, in whose name it is registered, and why it is registered in his name, and is there any dispute? If the dispute is there, so what is the latest status? And of course, the amount involved into that. So that information would be appearing in the notes to accounts of the company. After looking at that and after verifying that only, auditor should be giving this report. Because just now I mentioned about sometime different information given in the financial statement and different in the auditor's report. So this was one of the examples where company has mentioned that one particular immovable property is held in the name of the director, and they gave that detail also in the notes on accounts. But the auditor has mentioned that all the title deeds of immovable properties are in the name of the company. So please, that's the point which I wanted to highlight in this. Coming to the deep part of it, which is the last part of it, whether the company has revalued its property, plant and equipment or intangible asset or both during the year, and if so, whether the revaluation is based on the valuation by a registered valuer, and specify the amount of change if change is 10% or more in the aggregate of net carrying value of each class of property, plant and equipment or intangible asset. Now, the clause C as well as clause D. Now, see, the background of these, bringing in these, adding these, some of these clauses is again from the experience regulator had from the various cases which were presented before NCLT by banks for their resolution process. So it was found that in very large number of cases, properties are in the name of not in the name of the company, and still they have based on misrepresentation or some connivance, they have obtained loan on those properties from banks, and at the time of winding up or realization, it was found that those properties cannot be charged by the company because they are not in the name of the company. So therefore, the requirement of title deed in the name of the company is important. Similarly is the valuation. Number of cases were noticed where the bankers have given huge loan to the companies based on a valuation by the valuer. But when those companies went into liquidation before the resolution process, it was found the properties, the value of the properties is very low. But whereas the reports which were there with the banks were showing very high value. So that was another malpractice which was going on in the banking sector in connivance with the companies as well as with the bankers. So therefore, this new requirement has been brought in. So, first of all, it says that if company has revalued, it has to be done by the registered valuer. So, Section 247 is the section which is now into full operation, and it says that there has to be a registered valuer. Any valuation under the Companies Act, required under the Companies Act, has to be done by the registered valuer. A valuer who is registered with IBBI, has hold that certificate of registration from IBBI, and accordingly he is only entitled. And there are three categories of valuers. So it has to be done by a registered valuer who is entitled to do valuation of property, plant and equipment, and or intangible asset, as the case may be. And that is the one part. And the second part is, if the valuation, there is a change in the valuation either side, 10% more, or if there is a more, if change is 10% or more, change both sides, plus or minus, then this has to be reported by a specific para, that during the year the company has revalued its building, and the value by the registered valuer, and the valuation is the change in valuation is 15% less than, and then maybe amount can also be given accordingly. This type of information is required to be very specific information is required to be reported. So you can also see that this is again a statement of facts which auditor has to verify from the records of the company and report accordingly. There's nothing, there is no, auditor is not expressing any opinion here. Right? It's a statement of facts. So the last clause in this particular, last subclause in this clause I is relating to another aspect, which is whether any proceedings have been initiated or pending against the company for holding any Benami property under the Benami Transaction Prohibition Act 1988 and the rules made thereunder. If so, whether the company has appropriately disclosed the detail in its financial statement. Now here, if you can see, the again, company has to first disclose the details, and if company, there is any proceeding going on against the company for holding any Benami property, then first company has to report, and then auditor also is required to report. Now there may be one question in your mind, that how auditor is actually going to do anything reporting under this act if company says that there is no proceeding pending or initiated against the company under the Benami Transaction Prohibition Act. So auditor has to do some extra exercise. They have to, we call it some special skepticism. There has to be some more additional inquiry from the auditor side. He has to, so another one type of inquiry which I can share with you is, let's say, looking at the expenses incurred by the company for legal expenses, as legal expenses. If you go through those legal expenses, and if you find that some lawyer or some legal proceedings payment has been made to some lawyer for handling a particular case which is under the Benami Property Act, so that can be a indication. So asking for details of pending litigation, and then also verifying all the invoices where payments has been made to auditors, that is paid to the lawyers, reviewing that and trying to find out if any such procedure is one additional audit check which has to be done to really make the proper reporting under this particular subclause. So these were clauses which were relating to primarily property, plant and equipment as well as intangible asset. Now let's move to the clause 2. Clause 2, these subclauses under clause 2 are relating to inventory held by the company. So here, if you look at the subclause A of clause 2, let's first look at the structure and then we will discuss it. Whether physical verification of inventory has been conducted at reasonable interval by the management, and whether, in the opinion of the auditor, the coverage and procedure of such verification by the management is appropriate, whether any discrepancy of 10% or more in the aggregate for each class of inventory were noticed, and if so, whether they have been properly dealt with in the books of accounts. Now you can see here there are primarily three major steps. Or rather, I would say, three. First is whether physical verification has been conducted at reasonable interval with the management. That is the first aspect. Then second is, see, if you look at the words which I have in the slide, those are cut. Any material discrepancy were noticed. So in this particular clause, now the regulatory authority deleted these words because they gave a threshold of 10%. So rather than now looking at materiality aspect in each and every case, now there is a rule-based reporting. It says that if discrepancy of 10% or more in aggregate in each class of inventory is noticed, so that is considered as technically considered material discrepancy and is required to be reported. That is the second part of it. Third part is the coverage, which is where the auditor is required to express the opinion. So now what is the requirement? It says the coverage and procedure of such verification by the management is appropriate. See, if you look at our essays, standard on auditing, so there are which mandates that auditor is required to be present to look after, to overview the physical inventory, verification of inventory process which management adopts. So they have to verify the procedure, the coverage also. So now that there is a specific reporting, which is the auditor has to express his opinion. The coverage and procedures of such verification was appropriate. So that's a major, very important opinion which is required to be expressed. And then finally, if there's a discrepancy noticed, and whether how it has been dealt with, whether it has been properly dealt with in the books of accounts. So properly dealt with in the books of account means if it is not there, has that been removed? And if it has something has been found, has that been brought to the inventory? So these are to be considered as properly dealt with in the books of accounts. And this is the wholesome requirement under this inventory. So one very important point which emerges from here, and that is there may be a debate or sometime we make up our mind that we are reporting in CARO, something we are reporting in CARO. So since we have already made reported in something in the CARO, so therefore there is no need to report anywhere else. But this is one point which I am why I wanted to, which I want to bring to your kind notice, is that there are going to be certain observations in CARO which would have an impact on your reporting of true and fair under subsection 2 and 3 of the section 143, which is the main report. So this is just one example. Suppose here you find that, in your opinion, the coverage and procedure of such verification by the management was inappropriate. So this reporting will lead you to do something more in your audit procedures and accordingly make up your mind, will force you to make up your mind whether it is having any impact on true and fair view of state of affairs of the company as on the reporting date. So this is just one example. Some few more of such example will appear in CARO 2020 reporting. So the point which I wanted to highlight here is that whenever you are reporting, whenever there is a qualification or any adverse reporting in CARO, always check whether that has got any implication on the true and fair view and report accordingly. So let's move further. So in clause 2, subclause B has been added. Now this is very, once again, a banking sector requirement only. See, all of us are very familiar with the bank audit. So whenever we go to the bank audit and we verify the cash credit limits, various cash credit limits sanctioned by the bank and dispersed to its borrowers. So we always ask whether the company has filed statement of its current assets, or sometime its trade receivables, or its inventory. So most of the time we find that those are not there, or sometimes even if they are there, the bank has not done anything to really to calculate the drawing power, and based on that any adjustment or any release of working capitals has been adjusted accordingly. In some cases it happens also, but so that is the point. So keeping that point in mind, and again it was noticed in very large number of cases when they went before the NCLT, that the cash credit limits enjoyed by the companies were far more than the current assets, based on the security of those current assets, those limits were granted. So when this was examined, why it has happened, so it was found that they have not submitted any statements of their security of current assets to the banks on periodical basis, in spite of the fact that in most of the sanction letters, it was a condition that the company would be filing periodical, sometime monthly or sometime quarterly returns of their current assets, which is part of the security to the bank, and based on which the drawing power will be determined, and limits will be released to the borrower accordingly. So keeping that in mind, now this has now been brought into the CARO reporting also. Of course, there is first it has to be reported by the company, and if you look at the company reporting, it is very exhaustive reporting. Company is required to report in the financial statement that the quarterly returns or statement which they have filed with the banks or financial institution from where they have enjoyed the cash credit limits based on the security of current assets, are they statement which has been filed with the bank are in agreement with the books of accounts of the company or not. So this information is required to be seen on quarterly basis. So each quarter, and accordingly the stock statement sent to the bank is to be verified. And then if there is any difference in the two, then what is the difference? That difference is also required to be disclosed by the company in the financial statement. So auditor is required to report? There are, first of all, the companies are required to give this reporting for all working capital limits, irrespective of the threshold. Whereas the auditor is required to report only when the sanctioned working capital limit is in excess of 5 crore rupees. So please mind the word sanctioned working capital limits. The company has been sanctioned and need not be necessarily the disbursed. So that is one point. Again, it was noticed by FRRB in one of the cases where the sanction limit was more, but the disbursed limit was less. But so the reporting was required because here the word uses sanctioned working capital limit. So this auditor has to verify. Now, number of times you will face a situation where you will find that company has not prepared their quarterly results. So far as listed companies are concerned, or sometimes the companies which are having very large turnover, or so they prepare their quarterly results. But all such cases where companies are not preparing quarterly results, how to really verify this? That is a question which normally a lot of members face. So here, and another important point, or rather I would say a deficiency or malpractice which was going on, was that companies used to file a stock statement or security statement not as on 31st March, rather they were filing as on, let's say, 15th March or sometime 28th February, or is similarly in the case of quarterly return also, they were filing it on a different date, as on a different date. So here again, the guidance note is has given a very detailed guidance how to really deal with these situations. So far as books not closed on quarterly basis, the auditor is required to obtain the the trial balance and the stock statements, and based on that, he has to verify that. See, another very interesting point in this case is that when you look at the drawing power, you always find that drawing power is determined based on the amount of current assets less current liabilities. So it means the unpaid stock is not considered as eligible for financing by the banks, because then it will tend to amount to double financing. Company has not paid to the trade payable, and has on the other hand, on the same material, he has taken loan from the has taken limit from the banks. So to therefore, this whenever the quarterly returns or statements are being viewed, so ensure that the entire information of uh, calculation of drawing power is also verified by you, because ultimately the objective of this clause is to ensure that working capital limits are not used excessively where the actually the drawing power is not there, and still companies enjoying more, maybe for a reasons I don't want to say at this stage, because sometimes they, with the bankers, they have this kind of understanding. And so the point here is that this is a important reporting, and a lot of this information is very relevant to bankers also. And so far as that stock statement of different dates are concerned, then auditor is required to ask the company to prepare a reconciliation. For example, let's say they have submitted a stock statement on 15th of March. So from 15th March to 31st March, how much was the receipt, how much was the issue, and what is the balance, and whether that balance tallies with the closing inventory list which has been there. This type of exercise has to be done, and only then it would be the reporting would be proper. And once again, this is another important reporting which may have a if it is material, may have an impact on the true and fair view of the company, of the company's affairs, and accordingly has to be viewed from that point also. Yeah. Now let's move to the we are going very slow. Let's move to clause number 3. Clause 3 is very exhaustive, one of the most exhaustive clauses I have seen in CARO reporting is clause 3. Now, if you look at the opening structure of this particular clause, it says whether during the year the company has made investment in, provided any guarantee or security, or granted any loan or advances in the nature of loan, secured or unsecured, to companies, firms, limited liability partnerships, or other parties. If so, then the reporting, there are 6 reportings which are coming. I'll come to that. Let's first understand the opening para itself. So if you look at the words which has been cut in the slide, you can see that covered in the register maintained under section 189 of the Companies Act 2013. So it means the earlier reporting, which was in 2016, this reporting was only with respect to related parties, because all those parties which are covered in register maintained under section 189. But now, since those words has been deleted, so it means now this has to be seen from this 6 paras which are going to be reported, has to be seen with respect to all transactions which are there. And now 2-3 more transaction has been brought in. Earlier, companies has granted any loan. That was the only requirement. Whether the company has granted any loan, secured or unsecured, to the companies. But now, made investment in. So any investment made by the company is also required to be examined for reporting in 6 clauses, which I will come later. Similarly, provided any guarantee or security, it means the non-fund based lending. So wherever company has stood guarantee for someone or has provided security to loans to someone, some other company, that is also covered. And another aspect of advances in the nature of loans. Loans is one. Another type of transaction which has been brought in is the advances in the nature of loans. This is a very important, because this requires your attention. Some of the, if it is loan, so company must have classified that under the head loans itself. But advances in the nature of loan are, sometime merged within the trade payables or something like that. Advances in the, sorry, not trade receivables, and then technically they are not visible. So now, what are those advances in the nature of loan? Let's first understand. Sometime companies structure the advance in such a way that where the idea is not to receive any goods or services against those advances, but they are technically in the nature of loan, but actually no interest or interest is being charged for that, for whatever reasons. And sometimes this also is a practice that these transactions are entered into in the beginning of the year, and by the end of the year they are squared up. So take a case where company has borrowed certain funds from the bank, let's say at the rate of 11% interest, and they have 25% of that has been given to a company where directors are interested as advance. And by the year end, it has been received back. So now what has happened during the entire year, the funds has been used by a related party and no consideration. So first of all, they have flouted the provision uh, of section 186, as well as no interest is being charged. So it means it is prejudicial to the interest of the company also. So that's why these words, advances in the nature of loan, is also required to be examined. Similarly is the case of investment in. Now see what was happening in very large number of cases. It was noticed that loan is given. So once loan is given, then it requires servicing of loans. It means that interest has to be provided, TDS has to be deducted, and so many. So what companies were manipulating, instead of giving the loan, they were investing in that particular company. And so since once it is invested, so no interest is required to be provided for. So therefore, investment is also a important outflow from company's point of view and requires reporting on certain aspects, which I am going to come to that. So scope of this reporting has increased. Then it is not limited to related parties. These are two steps, two aspects you must consider. And then now let's move to the reporting requirement. What is to be done with regard to investment? What is to be done with regard to guarantee and security, granting of loan, advances in the nature of loan? First, so in clause A, subclause A, then two paras, capital A and capital B, have been added. These are with regard to loans, advances in the nature of loans, guarantees, and securities. So investment is not there in this particular. So rest all are covered. And again, this this reporting is not applicable to companies whose principal business is to give loans, because then they would be, since that is their business, so definitely they would be giving loans and standing guarantee or providing security. So here it says that if this has been done, the aggregate amount during the year and balance outstanding at the balance sheet date with two subsidiaries, joint venture and associate. So the information now they are trying to bifurcate that with the related parties. If the related party is a subsidiary, joint venture, or an associate, then this information, how much is given to them, and what is the total percentage as compared to the overall loans and advances in the nature of loan given, then that is to be shown here. So that gives an indication that the related parties, how much such loans has been given to the related party, which are subsidiaries, joint ventures, and associates. Then this is the this particular reporting is the main and very crucial to my mind. Whether the investment made, guarantees provided, security given, and the terms and conditions of granting of all loans and advances in the nature of loans, loans and guarantees provided are not prejudicial to the company's interest. Not prejudicial to the company's interest. Now, we have to examine each and every transaction on this test. What is that test? Is not prejudicial to the company's interest. So if investment has been made, so your question would be why this investment has been made, what is the company's interest, how company is going to get benefited by this investment. So all those aspects has to be checked before you really say that this investment is not prejudicial to the company's interest. Similarly, any guarantee given, security given, any loan granted, advance in the nature of loan granted, and their terms and condition. When uh, for what period, whether it's secured or unsecured, how much interest is being charged, how interest will be serviced, all these are the conditions. Now you have to see whether these are prejudicial to the company's interest. Let me give you by way of one example. Company has borrowed funds from, let's say, from the bank, let's say by way of a term loan or even working capital limit, and company is paying interest at the rate of, let's say, 11%. Now the company has granted loan to its to a company where they are charging interest only at the rate of 10%. So it means that borrowing funds at 11 and lending them at or giving them at the rate of 10%, it cannot be in the interest of the company. So company is losing. Why company is doing this transaction? There can be this type of company is required to repay the loan in 1 year, whereas the loan granted is for a long-term period, for after 5 years. So it means that that mismatch has been created, where short-term funds has been given given to the company as a long-term. So that is also cannot be considered as in the interest of the company. So those are areas which has to be examined and then accordingly report accordingly here. So once again, I would draw your attention, since it is a expression of opinion. Now you are expressing the opinion based on the facts of each and every investment made and loans granted, advance in the nature of loan, and then comment upon that these are not prejudicial to the company's interest is a very important reporting from your side. Now let's move to the E, new subclause which has been added here. Now here what they are trying to say, this is again a malpractice which was going on in banking sector, where evergreening of loans was being observed by the regulator when those cases were sent to the NCLT and ED or CBI were examining. So they found that there was evergreening process going on. And what was that process? The one particular loan was due, and it was overdue. So that it should not go to the NPA side, another loan or advance in the loan was granted, and then that fresh loan which was granted was used to settle the overdue of the existing loan. This way they so it means that that particular account which was otherwise going as NPA, that was saved, and that was this type of malpractice was there. So auditor has to really be very careful in looking at it, and especially when there is an overdue amount, how that overdue amount has been paid. That entire cash flow has to be looked at by the auditor, whether from where that loan, the amount has been brought in to pay the overdue. There is one interesting example. I think it is there in the guidance note also. The company has a balance. There was a term loan. There was a cash credit limit with the bank. There was a term loan which became due on a particular date, and there was cash credit limit. Some unutilized limit was there. So company has paid from that unutilized limit to term loan. So this is not considered as evergreening, because ultimately that working capital limits can be used for repayment of interest and term loan installment, because ultimately that has to be paid from the working capital, working of the company itself. So that this type of observation has to be seen, how that overdue part has been of existing loan has been settled. So this is again a very real audit exercise has to be done, and you have to ensure by way of getting the cash flow statement prepared in such cases, and ensure that fresh loans, that evergreening process is not the case is not there in such of cases, and report accordingly. Another clause, whether the company has granted loan advance in the nature of loan, either repayable on demand or without specifying any term of payment of repayment. If so, to specify the aggregate amount percentage thereof to term loan granted, to the overall granted to promoter related parties. And so now this is see a separate reporting. At this, while reporting this, you have already examined the prejudicial interest of the company, whether that is prejudicial. So here you are not, it is, you are only, here it is only a statement of facts, that how much loan are those loans which are repayable on demand, and then out of that, how much has been granted to promoters and related parties. So that percentage of those loans, total loans, and versus loans given to promoters and related parties, where loans are either repayable on demand or where there is no, without specifying any term or payment of repayment, that is required to be mentioned, given here. Again, please look at this point when you are reporting under clause 3, subclause B. That is a separate exercise, because there you have to express your opinion. Why it is, for example, you will be examining when you are supposed to term loan, you are supposed to give on repay on periodical basis. How can you give loan out of that which is repayable on demand? Then you have to arrange funds from some other sources to ensure that your term liability is taken care of. So this aspect has to be examined here, but here it is reporting only of the facts, that what is that percentage. Clause 4 is with regard to the provisions, compliance of section 185 and 186 of the Companies Act, where whether those has been complied with respect to loans, investment guarantees and securities, because it restricts, 185 restricts to whom it can be given and to whom it cannot be given, and 186 deals with the overall limit to this extent, and how that can be done by taking approval from the general meeting up to 60% and all that. So those section 185 and 186 requirement, there is no change in this reporting. Earlier also we were reporting in the same fashion. Coming to the clause 5, in this clause, this clause is relating to deposits. Now, again, there is not much change here in this reporting. The only change which is compared to CARO 2016 is that they have brought another words called amounts which are deemed to be deposits. So what are amounts which are deemed to be deposits? For that, you have to look at sections 73 and accordingly go through the company's acceptance of deposit rules 2014, and there the definition of deemed deposit is given. So what are those deposits which are amount which are deemed deposit has to be seen there, and accordingly reporting has to be done. Here the section 73 and 276 deals with that. In the case of where company is allowed to accept deposits, public deposits, and where the company has accepted exempt deposits, all those provisions has to be seen, and that reporting is only with regard to public deposits in this particular clause. Clauses number 6, 7A and 7B. There is no change because of the paucity of time. We have to rush. I'm sure since 2015, you are reporting on these aspects and there is no change. So I can safely skip unless you have any specific query on that. So these clauses are with regard to cost records and the regular depositing of undisputed statutory dues, and if there are if there is a dispute, then where those disputes are pending and how much is the amount involved, these are the reporting under these two clauses, 6 and 7, 7A and 7B. Now, clause 8. Clause 8 is another very interesting clause which has been brought in. Now, this clause deals with an aspect which is relating to income tax. Number of times it has been found that during the income tax proceedings, sometime companies, if there is any search and seizure happened on the company or onto the directors of the company or whatever, so they sometimes surrender certain assets or they surrender income during that year. This tax assessment may be relating to any earlier years also. But if this has happened during the year, so then those assets which has been disclosed or surrendered as income, how they have been dealt with in the books of accounts, that new aspect has been now required to be reported by the auditors. See, let's take a case. Company, there was a search, and the search party found a huge stock lying in the company premises, which were not there in the books of accounts. So they surrendered. They say, yes, this is our account, and accordingly, whatever was the value based on that which they have paid the tax. It means they have declared that as their undisclosed income and tax has been paid thereon. So now once that tax has been paid thereon, what happened to that stock? So it means now that stock has to be brought into the books of the company. And accordingly, so whether that part has been done or not, that is one. Similarly, the case can be in the case, suppose they have found huge cash or jewelry or whatever with the company, or any bullion or maybe foreign currency. How that has to be, if it has been surrendered, then. So first of all, when we say it has been surrendered or disclosed as income, so it means it has already achieved a finality in that particular year. Number of times it happens that though they have given a confession statement at the time of surrender, they have surrendered, but later on that statement has been retracted by the company. So those cases will not fall here. It means if it has been retracted, it means they are disputing that intention of the department to treat that as a undisclosed income. So those cases will not. This is all those cases where it has taken the finality, surrendered, disclosed as income, no further litigation. After that, what has happened, whether that has been. So this is the reporting requirement here. And again, now look at this. Again and again, I am taking you to the main report. Now, suppose there is a very large stock has been surrendered and it has not been brought to the books of accounts. You have reported here. Will it be sufficient? No. So it means that this definitely have an impact on your true and fair view. So accordingly, you would also be taking this type of observation reporting here also, as well as examining its impact on the true and fair view reporting in the main report also. There is another clause, clause 8. This clause has now, this was earlier clause 8, now has become clause 9. Whether the company has defaulted in repayment of loan or other borrowing, or in the payment of interest thereon to any lender, if yes. So these are the defaults which companies are required to report. Earlier it was clause 8, so there's not much change. The only change here is the earlier it was only with regard to repayment of loans, a principal amount, but this time they have also ensured that interest aspect is also brought in. And earlier it was only in the case of banks, institutions, or government or lender governments, whereas now any lender, if there is a default in the repayment of loan or payment of interest, so this reporting is required to be made. Whether the company is declared willful defaulter by any bank or financial institution or other lender. Now, this is once again, first verify whether the company has made any such disclosure in the financial statement as part of additional regulatory information. If it is there, then accordingly you have to report here. So what are the additional checks and balances you would be making here to ensure this? So first of all, let us understand what is willful defaulter. Willful defaulter is a well-defined term. It is defined by the Reserve Bank of India through a notification. It says that if a borrower has money but still not paying, number one. Number two, if the borrower has siphoned off the funds, then that is a second situation. And third, if he has diverted the funds. Siphoned off means that he has shown expenses and there is no fund left, or diverted means the funds has been given to some other company or related party or something. And the first one is that though they have funds, but they are not consciously, they are not repaying it. So in that situation, the bank can declare that party as a willful defaulter. This is a very exhaustive exercise which banks has to do, with very precision. They have to give an opportunity to the company why they are not paying and and after considering their representation as well as giving them full opportunity, only then they have to declare willful defaulter. So what is done when they are declared default? Bank has to give a public notice in the newspaper. They declare that such and such person is being declared as a willful defaulter, so that is the exercise. So what auditor has to see, obtain confirmation from all the banks and institution or lenders. So now what additional point while getting the confirmation from the bank, wherever there is a default in repayment of principal or interest, also ensure that you get a confirmation from the bank that the party has not been declared as a willful defaulter by the bank. Or another very important aspect which has to be considered is that in the case of consortium banks, when there is a consortium lending, where large number of more than one bankers are involved in giving loan to the bank, to the company, it has to be seen that if whether all the participants in that consortium are to be checked whether they have declared, any of them has declared willful defaulter. Though in such cases, banks has also been instructed that if any consortium member has declared a company willful defaulter, others should also be looking into that aspect. But sometimes situation becomes such that the management or company is ensuring all the payments in one bank so that they can continue with the transaction with that bank, whereas in other cases they default. And so accordingly, take the confirmation from the bankers, all the lenders, and then see whether in the case where there is a default, the confirmation is also available that whether the company has been declared willful defaulter or not, and report accordingly. Coming one more point with regard to clause 9 is this subclause C. This is relating to the utilization of term loan. As it has been observed that companies use their long-term funds for short-term purposes, or rather they don't use the funds for which those terms loans were raised, were obtained. So therefore, this reporting is important that whether the terms loans were applied for the purpose for which the loans were obtained. If not, the amount of loans were diverted and the purpose for which it is used may be reported. Now, if you look at the guidance note, one more aspect has been mentioned here, that this position has to be seen at the year end. So if, let's say, during the year, some term loan for whatever, for valid reason, they were diverted, but at the year end, they have been used for the purpose for which those loans were obtained, then auditor need not qualify here. See, the example can be like normally terms loans are disbursed not total amount in one go. They are also released in tranches, but in some cases they release the entire amount also. Suppose that entire amount has been released, but the company is required to give only advance for, let's say, for 6 months, and balance is to be paid after 6 months. So for 6 months, normally companies put that money into in some place where they at least earn that much, which is required for which is there up to the interest which is going to be charged by the bank for the term loan. So that is, sometimes they put it into mutual funds and all that. That is all permitted, so long as by the year end they are applied for the purpose for which they were obtained. If not, then auditor is required to report how much funds are diverted and where they have been diverted. That report is required to be given here. So on the similar lines, now you can see here, this is on the short-term funds side. Whether funds raised on short-term basis have been utilized for long-term purposes. If yes, the nature and amount to be indicated. Now, this is very important because number of times it has been seen that companies get into trouble if they don't have sufficient working capital with them. because that triggers their their process where they can sometime even fail. So from that point of view, it is very important that short-term funds are not used for long-term purposes. Means from working capital, they have acquired the plant and machine, property, plant and equipment, or let's say they have acquired a new building, which is it means that funds will never be available for the company for its working capital. So working capital shortage would definitely lead to financial problem for the company. So therefore, this reporting is important. And so how in these two cases, how you are in terms loan as well as in the short term, in the case of working capital, how you would be see. So you have to ask the company to prepare a cash fund flow statements. Whenever there is a release of term loan, how that has been utilized. Whenever there is a working capital limit, how much is remain invested in the current assets, and whenever there is a purchase of long-term asset, or let's say property, plant and equipment, then from where that fund has been used. So these are the questions which you have to ask, and after getting the information, you would be reporting on these two aspects. Whether the company has taken any funds from any entity or person on account of or to meet the obligation of its subsidiary, associate, and joint venture. If so, details thereof. So now here, which is talking about the funds has been obtained to ensure the to meet the obligation of its subsidiary, associates, and joint venture. So it means funds has been raised in the company, then transferred to the subsidiary, associate, and joint ventures to meet any specific obligation. There, for example, if there is a subsidiary has obtained a loan and they have to repay, they don't have funds, and company has raised the funds and given to that company for repayment to meet the obligation. These are the reporting requirement here. And on the similar lines, there is another reporting where the company has raised loans on the security held by subsidiary, joint venture, and associate companies. So both sides information, funds going from the company to subsidiary companies, subsidiary and joint venture associate, and other side, funds from subsidiary, joint venture, and associates going to the holding company, or their assets, funds are being raised based on the pledge or security of the assets of the subsidiary, joint venture, associate. Both are required to be reported. Now come to subclause 10. This is earlier also this was there. Since earlier the clause was both with regard to fund raised through IPO or FPO, and as well as for the term loan. But since now we have very detailed clauses with regard to clause 9, we have separately reported on term loan. So therefore, in this clause, term loan is not added. So only if company has raised money through public offer, whether it's an initial public offer or further public offer, or through raising through debt instrument, then see, whenever these funds are raised in the red herring prospectus, there is a purpose mentioned for which these are to be applied. Of course, SEBI regulations also requires a lot of certification by the auditors at each stage to report whether those funds has been used, fundraise has been used for those purposes for which they have been mentioned in the red herring prospectus. But in the main report also, this reporting is required to be made for all the stakeholders. Now, this reporting requirement is with regard to the preferential allotment as well as private placement. As you are aware that we have two sections, section 42 and section 62, and the related rules has given a detailed process which has to be adopted when where the company wants to see wants to raise funds by making preferential allotment or by private placement of shares or convertible debentures. I'm sure that you have heard about a lot of companies, NBFCs raise funds by private placement of their debentures, or sometime placement of shares, or sometime they do even preferential allotment also, and thereby they sometime flout the section which are the public deposits section. Those non-compliances are there. They try to circumvent those provisions. And here also, whenever there is a preferential allotment, whenever there is a private placement of shares or debentures, the sections required that the purpose for which these funds are being raised, because these are considered as special occasions. Otherwise, shares are allotted to as a right shares to all the shareholders, existing shareholders. And when there's a preferential allotment, that it means that shares are being allotted to a specified or a group of specified persons only. So why that investment and where the funds are going to be used, that is clearly mentioned in the various filings which are being done under these sections. And auditor is required to verify that the funds which has been raised through these preferential allotment or private placement are being used for the same purposes for which they have been raised. And if not, then where they have been used, how much amount is involved, that is the reporting requirement. New subclause 11A. 11A is with regard to the reporting of fraud. Whether any fraud by the company or any fraud on the company has been noticed or reported during the year. If yes, the nature and amount involved is to be indicated. Now, you can very well see here, by its officer or employees, these words has been removed, and these were there earlier because then it was restricted. Now, any kind of fraud by the company or on the company is required to be reported, and then amount, nature of fraud and amount involved is also required to be reported. Now, this is another clause. Once again, don't leave this. If there is any qualification here, don't leave this clause simply here for and also look at its impact on true and fair view of the state of affairs. New clause 11B. Whether any report under subsection 12 of 143 has been filed by the auditors in form ADT 4 with the central government. Here you have to simply report whether such any such report. Now look at this section 143 subsection 12 requirement. It says that if auditors find any get any information that there is a fraud or suspected fraud, then he has to file a report with the ministry in form ADT 4. That is the requirement of subsection 12 of section 143. So since that report was between auditors and the regulator, and it was not the fact was not made available to the other stakeholders. So therefore, this new clause has been brought into the reporting, where now auditor is required to report whether any such report has been filed with the central government, then that has to be mentioned there. Subclause 11C is with regard to whistleblower complaints. If you look at section 177 of the Companies Act, which requires to specified companies that they have to have a whistleblower mechanism in the company, and where any employee or anyone can make any complaint, and how, and the company has to come out with whistleblower complaint mechanism, how the complaint will be lodged, where it will go, who is going to take action, and how audit committee chairman is going to be reported for that, and all that. So auditor has to simply look at the process and ensure that that whistleblower complaints have been received during they have been considered by the respective authorities, whether it is audit committee or by the board, and that is the only requirement which auditor has to see in this particular clause. So far as the managerial remuneration is concerned, there was an old clause 11, which has now been deleted because now this Schedule 5, Section 197. Now, since there is amendment and no restriction is imposed there, so this reporting has also now been removed. Now, let's come to the clause number 12. So far as clause number 12, subclause A, B is concerned, there is no change, but a new subclause C has been added. Now, this, first of all, this clause relate to Nidhi company. So in Nidhi companies, there are two specific requirements. One is with regard to net owned funds to deposit, and another is with regard to maintenance of 10% unencumbered deposit, term deposit, with the as per the Nidhi rules. So these two reporting are there. In addition to that, one more reporting aspect has been brought in the case of Nidhi companies. So this reporting has to go only in the case of if it is a Nidhi company. Whether there has been any default in payment of interest on deposit or repayment thereof for any period, so that is also now required to be reported here. So far as clause 13 is concerned, this is relating to section 177 and 188 of the Companies Act. These two sections are relating to related party transaction. Section 188 deals with the related party transactions, and section 177 deals with the audit committee, and how audit committee is going to approve the related party transaction, all that omnibus approvals and subsequent approvals. Those are there in these two sections. You have to ensure that related party transactions, first of all, whatever related party transaction which you have identified, which has been reported by the company in the financial statement, and you have seen the compliances of section 188. In 188 has got two parts. One where there is a board approval, and if the transactions are beyond a threshold, then there is a prior approval of general meeting also. So all those compliances has to be seen, and accordingly the details has been disclosed in the financial statement. So now you can very well see here there is a section 180. The compliance is 188 and 177. But when you come to the reporting part, that reporting is as per the accounting standard, and there something more, some additional transactions like loan transactions with the related parties are not covered in 188 but are required to be disclosed in the financial statement. So accordingly, so far as reporting part is concerned, that is also required to be verified by you. This another clause which has been added is clause 14. Now, this particular clause is relating to internal audit system. As you have seen that now section 138 or 138 or which section? My God. Yeah. Yeah, sorry, 138 only. So section 138 of the Companies Act requires specified companies to have internal audit system in place in that company. So in those cases, auditor is required to verify two things. If you look at the structure of the section, it says that the internal auditor and the management of the company will frame the internal audit system. The size and nature, looking into the size and nature of its business, and they will decide what is to be checked, how much, when, the periodicity of to whom to report, and all that are part of their internal audit system. But auditor has to look at that aspect, whether that whatever the system which they have set up, whether that is commensurate with the size and nature of its business or not. Because they may set up their internal system looking into their requirement. They feel that this aspect is important, and they only try to restrict the internal audit system to that particular area, and they ignore the other. But auditor has to verify, auditor has to apply his mind and to analyze whether the internal audit system is commensurate. It has been seen in some of the cases, though internal audit system is there, but the reporting and its subsequent closure of the observations of the internal audit, how they have been dealt with, have they been finally gone to the audit committee or not? That is one aspect. So looking at the entire situation, auditor has to assess whether that internal audit system put in place by the company is commensurate. Similarly, the auditor also has to see that reports of the internal auditor have been considered by them or not. So this is by the auditor himself. I'm sure this is a very, in fact, whenever you are starting a particular audit, and if there is an internal audit system in place, at the time of deciding the scope of your audit itself, or deciding the audit program itself, framing the audit program itself, you take into consideration the scope of internal audit, how they are reporting, to whom they are reporting, how the reports are being dealt with. So it means that their reports are considered by the statutory auditors. So this is the point which you have to report here. Clause 15, there is no change. This is with regard to non-cash transaction with directors and person connected with them. So this particular section 192 requires that if there is any non-cash transaction with the director, then the proper valuation is there, and valuation is done by the registered valuer, and the transaction is duly approved by the audit committee or the board, as the case may be, because then it is a related party. It is being done with the directors or person. So non-cash transaction are those transactions where the consideration is in kind and not in the by cash. So, for example, if auditor has uh, purchased a property owned by the company against the loan granted by him, so it means, or he has given another property and taken the property owned by the company. This can be a non-cash transaction. So here, valuation of both the properties, and based on that, visualizing whether that is the transaction is at arm's length or is there any, and accordingly, since it is a related party, then related party compliance of that section 188 is there or not, that also has to be brought in so far as non-cash transactions are concerned. Clause 16, this is with regard to non-banking financial companies. There some new changes has been brought in. First of all, it requires auditors to report whether the company was required to get registration under NBFC or not. So first of all, you must know what are those conditions which, if they are there, then company would be required to get itself registered under Section 45 IA of the RBI Act. These two conditions are if majority of the income of the company is from non-banking transactions. Second is, and majority of its assets are non-banking assets. Non-banking assets are loans, advances, investments, lease, money given on lease, hire purchase, all those. So that has to be, and if both the conditions are met, only then the company is required to get itself registered with the RBI. First of all, this is just a one side of this particular whole thing. If a company has done a business, first of all, you have to verify whether that is within the objects of the company or not. If it is not, then another reporting that the business has been done, ultra virus, all that reporting is also required to be made. So I am not touching that point at the moment. In clause 16, it is with regard to registration with the RBI, because they want to catch a lot of companies which are otherwise carrying on non-banking activities without obtaining the RBI registration. Number of times it has been seen that promoters incorporated a company for, let's say, to carry out manufacturing activity or do trading activity, but rather than trading or manufacturing, they have started now investing the entire amount into share market, and based on, so once again, looking at the definition, if the majority of their income is coming from share market, majority of their funds are invested in shares, then that company requires registration under RBI Act under 45 IA, and therefore this clause, this reporting from your side will highlight if that non-compliance is there. Whether the company has conducted NBFC housing finance business also, that is a new addition there. And core investment company. What is core investment company? There is a definition of core investment company which says that if 90% of the funds of the company are invested in group companies, where the 60% and more is into equity and balance is in the loan, and then this company, in spite of the fact it is carrying on NBFC activity, it will be considered as core investment company, and accordingly would be exempt to or unregistered CIC, because CIC if the asset size of the company is more than 500 crores, then it requires registration. Otherwise, a investment company which has fulfilled this criteria of 90% to group companies, where 60% is in equity, they can be considered as core investment company and still would not be required to get themselves registered as a NBFC. That is the one aspect here. So if there is more than one CIC, then the number is also required to be reported, because the RBI wants to ensure that simply by splitting and CICs, they are not going the beyond threshold of 500 crores, because they would be looking at all the CICs together and then see whether they would require registration within the group. So that is the requirement of this clause. Whether the company has incurred cash losses in the current year as well as in the financial year. If so, state the amount of cash losses. This is one just reporting. Let's, since we don't have much time, let's quickly, 2-3 clauses are there. These are important ones. These are all new clauses. The first clause is whether there has been any resignation of the statutory auditors during the year. If so, whether the auditor has taken into consideration the issues, objections, and concerns raised by the outgoing auditors. Now, this is very important clause, and important from this point of view that, first of all, if you look at section 140, it says that whenever there is a resignation by the auditors, auditor has to give the reasons why they are resigning. And when a new auditor comes in, he has to consider why the earlier auditor resigned, what were the issues and objections and concerns, if any, if it has been raised by the outgoing auditors, and how they have been dealt with. For example, let's take a case where the outgoing auditor has mentioned that the company management is not willing to place financial statement of this particular unit of the company, and because of that we are not in a position to we don't want to give an even disclaimer report, we don't want to accept the assignment, and we want to resign it. A number of, see, if you look at our SQC, number of situation can arise where auditor would resign. So in those situations, if the incoming auditor has to ensure that whatever issues, objections, and concerns have been raised, they have been properly dealt with by him while carrying out the audit of that particular company. Now, this is the most important clause, clause number 19. Now, what is that? Look at the requirement. On the basis of financial ratios, aging and expected date of realization of financial assets, payment of financial liabilities, and other information accompanying the financial statement, the auditor's knowledge of the board of director and management plans. Now comes the important part, whether the auditor is of the opinion that no material uncertainty exists as on the date of audit report, that company is capable of meeting its liabilities existing at the date of balance sheet as and when they fall due within the period of 1 year from the balance sheet date. Now, first let us analyze what is the requirement. First of all, what are the information, additional information, which is now coming, flowing to the auditors. As you must have noticed that Schedule 3 has been thoroughly revised, where now company is required to present 11 financial ratios, and they have to also give the detail of the numerator and denominator, how that financial ratios has been arrived at, and if there is any change of more than 25% as compared to the earlier year, then they also have to give the details why that change has occurred. So that is the first information, additional information now available to the auditors. Similarly, not only the aging of the trade receivables. Aging of trade payables is also now available with the auditors, because that company is required to report in the financial statement. Similarly, auditors look into the minutes of the board of directors. They ask the management to give their plans, what are their future plans. So from that point of view, auditors are in a position to really make an assessment what is going to be the immediate financial position of the company. So now the regulator wants auditor to report. See, as you are aware that we have been very conscious about reporting. Where we are saying true and fair based on the based on the test checks or samples which we have never committed a very categorical opinion onto the company's viability or company's ability to pay its short-term or long-term liabilities. But this time, this new clause has been added, and auditor has been specifically asked to express his opinion. Now, the requirement is no material uncertainty exists. So still very safe. No material uncertainty exists on the date of audit report. Now, this is very important. Now, you are not looking at uncertainty on the reporting date, but on the date of audit report, which is in very large number of cases can go, let's say, right up to September. So looking at the information up to that stage, now you have to report that liabilities which are due, short-term liabilities, which fall due in next 1 year from the balance sheet date. So it means we are talking about only the short-term liabilities. Whether company is in a position to pay short-term liabilities, this you are reporting based on the information available to you on the audit date of audit report. So it means that aging, which is available on the reporting date, has to be updated up to the date of audit report, and then only auditor would be in a position to make this kind of opinion. So and the idea is that the short-term financial viability of the company is expressed by the auditors, since it is to be done on year-to-year basis. So I would say that regulator has really asked the auditors to give a very important opinion expression by the auditors through this particular clause. This clause 20 is relating to reporting with regard to corporate social responsibility. As you know that this section 135 as well as the rules has been amended extensively and now as per the new requirement, the CSR funds, whatever company is required to spend in that particular year, if it is not spent, then in next 6 months, company is required to deposit that unspent amount with any funds specified in Schedule 7. And if it is a ongoing project, it means that the CSR funds are going to be spent for a project which is for, let's say, for the period maximum for a period of 3 years. Then funds which are unutilized has to be deposited in next 3 months in special for that purpose. So auditor has to report on this. If you look at the reporting requirement by the company in the company financial statement, there's a very exhaustive how the amount was determined, how much is the amount, how it has been spent, if it is ongoing project, what is that project, how much is the to be spent on in the remaining period. And if it is even if in the case of section further goes, if it is ongoing project which can be maximum 3 years, after 3 years if it has not been spent, then again the subsection 5 would apply, and then accordingly the unspent amount has to be deposited in a with a fund specified in schedule 7. So this is the requirement of with regard to section 135. And the final is clause 21. As I was mentioning that now one clause, this is only one clause which has been now brought in, which is applicable to a consolidated financial statement. When auditor is reporting, giving a report on consolidated financial statement, that clause 21 would be applicable if that company is preparing a consolidated financial statement. What is the requirement? Requirement is that if in standalone financial statement, the CARO reporting has got any qualification, so that qualification has to be reported in CFS CARO reporting also. For example, if we say that subsidiary A of the company, auditor has reported the company has defaulted in repayment of company has utilized long-term funds for short-term purposes or for purposes which are not meant for which the funds were raised. So that qualification would reappear in CFS also. That is the only requirement. But otherwise, if there is no qualification there, no report will be, it will be added there that nothing is to be reported under clause 21 in the case of consolidated financial statement. I think these were so I think this we can leave. So I've taken 10 more minutes. So maybe if we can take some questions, if there are some urgent questions.
Sure, sir.
Yeah.
Good afternoon, everyone. I am Megha Saxena, Secretary to Auditing and Assurance Standards Board. On behalf of the board, I would like to extend a heartfelt thanks to sir for such an insightful and engaging session, and also for the lucid explanation and the practical illustration which he has added clause by clause, sir. You have made that session truly meaningful, sir. Thanks to you, sir. Now we'll be moving to the question answer session. So, sir, I would some questions which we have received with regard to applicability, and some of the questions that are pertaining to the specific clauses.
Okay.
So, yeah, the question number 1 is with regard to the applicability. The applicability of CARO on private company in the next year when applicable once in the previous year. I think he wished to ask that in case if the CARO is applicable for 1 year, will it be applicable for the next year also, or he has to see the conditions again?
It has to be on year-to-year basis.
Now, second, what are the amendments with regard to financial year 24-25?
With regard to?
With regard to CARO?
No, there is no.
There's no.
Yeah.
There's no amendment. Question number 3 is with regard to the clause number 2B for the working capital limit, that whether the limit of 5 crores is fund-based or the non-services are also included in it. In clause 3, loans and advances, etc., whether the loans and advances guarantee and the security is not reported in the earlier year, then how it will be treated in this situation?
See, normally working capital limits are, if you look at the B, sanctioned working capital limits. Working capital limits are never non-fund based. If you look at the overall limit, what happens? They give term loan, they give working capital, they also give non-fund based. So non-fund based limits, for example, let's take a case. They have given a bill discounting facility, which is a part of working capital limit. But till the time this bill discount is overdue and it becomes part of the working capital, part of the working capital amount, it will not. So point which has been raised is well taken. sanctioned working capital limit will include non-fund based, because non-fund based are sometimes mentioned as a subset of the overall working capital limit.
Yes, sir. Moving to the next question.
I'm
Whether
sure
the
I'm
CSR
clear on that. So overall work non-fund based is to be considered. Yeah, the correct answer is that, in short. Yes. Next.
Noted, sir. Noted, sir. Thanks. So CSR expenditure disallowed is required to be reported.
Yes. So in fact, there are two requirements so far as CSR is concerned. One is the unspent amount, whether that has been deposited in funds specified in Schedule 7. That is one. And the second reporting requirement is with regard to ongoing projects, where the funds not spent but kept for ongoing projects. So for whether they have been deposited in special account or not. So these are two reporting requirements so far as auditors are concerned.
Sir, there's one interesting question, that what should be the duty of the auditor if he finds certain negative aspect like non-registration of charges or variation in the stock statement submitted to the banks, but the provision of CARO 2020 are not applicable to the company as it is a small company.
Yes, very good point. See, as I think throughout my presentation, I was mentioning that simply reporting in CARO is not sufficient. If you at any point of time when you feel that this point has an impact on your main report, which is the true and fair comment, you should be considering that. So here you are the question which has been put, CARO is not there, but that point is there. So definitely you would be linking that point to the true and fair view, and accordingly consider that while giving the main report.
Very rightly pointed out, sir. Sir, you have well indicated that it is only the part of the legal and regulatory requirement section when we are reporting in the CARO. However, the over true and fair view of the company needs to be seen.
Yes.
So now coming to the next question, sir. It has been noticed that in many of the audit report, while reporting against para 2B, it is being stated the quarterly returns or returns or statement filed by the company with such banks and the financial institutions are in agreement with the unaudited books of accounts. Is this reporting correct?
See, but the fourth quarter cannot be unaudited. Na? Three quarter can be. First of all, it means that in this case, it is a company which is not going through the limited review also. I mean, it's not a listed company. Because in the case of a listed company, it cannot say unaudited.
Unaudited.
Right.
Very
but in
true.
the case of smaller companies which are not listed, where audits are not carried out on quarterly basis, for 3 quarters they can write, but fourth quarter they cannot write this.
A few very simple questions are there, whether it is applicable to the Section 8 company, which we have covered in the preliminary section. So
Okay.
it is, yeah. So these are the questions, and some question like that, whether it has the company has to satisfy all the conditions, or
That
it is
also I
connected by
explained.
or.
That also I explained in detail.
Yes, sir. Yes,
Each
sir.
and
Yes,
every
sir.
clause has to be reported. If some clauses are not applicable, you can club them in one para, that such and such clause relating to this is not applicable, and give as a one para.
What kind of data is required to be maintained for the intangible asset, including the physical verification?
The intangible asset physical verification is not there. It's only maintenance of records.
Yes, sir.
Yeah.
So what does a physical verification entails in itself? Is there a mere presence of the assets enough, sir, that we have covered, sir,
Yeah.
in detail? So I think that is sufficiently addressed during the session.
Yeah.
Right, sir. So, sir, with this, we have covered all the questions, sir. Only left the applicability portions of the questions. Otherwise, we have taken all the tricky portions.
Okay, good.
Thanks to you, sir.
Thank you.
The way you have connected the audience, as of now, we are connected with 2,000 plus participants.
Oh, beautiful.
So, yeah. So, sir, it is an enthusiastic participation by the members, I would say. So, which has made it the seminar more meaningful, because when we are listened by the mass, so that address our purpose.
That is the idea of the
Yes, sir.
webinars.
Yes, sir. Thank you, sir. Thank you for being with us, sir. It's a pleasure to have you, and we are looking forward to have more sessions with you. And for participants also, thanks for your patient hearing. And we would like that such enthusiastic participation should also be there in the future also. Thank you, sir. Thanks to all.
Thank you. Bye.